The market almost never collapses for the reason people were shouting about on television. That is one of the oldest lessons I know. The thing everyone points at is usually too obvious, too visible, too narrated, too clean. Real trouble tends to build in the plumbing, in the funding channels, in the quiet assumptions that supported a whole structure for years, until one day the assumptions stop cooperating and everybody realizes they were never studying one risk at all. They were studying a system. That is what I want to talk about. Not one scary headline, not one election, not one commodity spike, not one recession model. I want to talk about what happens when several fragile parts of the modern financial system start leaning on each other at the same time, because that is where real danger lives. The public loves simple villains: a bubble, a war, a politician, a bank failure, a recession indicator. Those things may matter. But the truly destructive moments in finance usually happen when something larger is hiding underneath, a structure so interconnected that no single headline can explain it honestly. The 2008 crisis looked to many people like a housing problem. That was only the surface. The deeper problem was that the entire financial system had attached itself to housing through layers of leverage, structured products, collateral assumptions, and false confidence in liquidity. When the original asset weakened, everything built on top of it started failing too. That is why 2008 became so catastrophic. Not because Americans bought too many houses by themselves. Because Wall Street and the banking system built an enormous tower on top of one vulnerable foundation and convinced themselves that complexity had made the tower safer. It had done the opposite. Complexity had merely hidden the fragility. That is why I have always preferred plain truth to elegant packaging. If a system is fragile, I would rather see the fragility early than admire how beautifully it was wrapped. That habit matters now because the current danger is not one clean story either. It is a stacked private credit, artificial intelligence, capital spending, Middle East energy risk, the long tail risk around Taiwan, and the semiconductor chain individually. Each of these subjects can sound manageable enough to the public together. They create a structure that deserves much more respect than the market is currently giving it. And I choose the word respect carefully. I am not talking about panic. Panic is lazy. Panic converts uncertainty into noise. Respect means understanding how the parts touch each other. That is always the right place to start. Now let me begin where I always begin. With the cash flows, the public often thinks artificial intelligence is mainly a story about software chips, clever products, and changing human behavior. Those are all real pieces of the picture. But there is another side to it that matters much more to markets. Artificial intelligence has become a capital expenditure event of historic size. Data centers, power cooling, transmission land, construction, long-term leases. Gigantic upfront commitments whose economics depend on future demand remaining strong enough for long enough to justify the build-out. That part matters because capital spending on that scale must be financed. And here is where the story becomes less glamorous. A surprising amount of this financing has not flowed through the cleanest, most conservative, or most transparent channels. It has flowed through private credit, off-balance sheet structures, private lenders, and funding arrangements designed to support huge infrastructure needs without showing all of the economic burden in the most obvious places. That does not mean every deal is unsound. It means the system carrying these deals deserves scrutiny. Private credit became popular for a simple reason. Traditional banks had constraints. Public debt markets had standards, moods, and timing issues. Private credit said yes when others said maybe later. Private credit promised flexibility, speed, customization, higher yield, and in a world where investors were starving for return and companies were desperate for capital, that combination was irresistible. But I have seen enough cycles to know something important. Any market that grows too quickly by advertising flexibility eventually needs to be examined for what that flexibility was hiding. Sometimes flexibility means intelligence. Sometimes it means standards moved lower than people wanted to admit. The same question always matters: who is borrowing at what rate? Against what collateral? With what cash flow? Under what assumptions about refinancing? Under what assumptions about the next round of growth? Under what assumptions about interest rates? And under what assumptions about what happens if the expected future does not arrive on schedule? Those are never glamorous questions. They are usually the important ones. This is where artificial intelligence financing becomes interesting in a dangerous way. The AI build-out is large enough that it almost required the market to bend in order to support it. Massive capital needs always change the system around them. If the build-out had been modest, perhaps ordinary channels would have been enough, but when the industry starts talking in tens of billions, then in hundreds of billions, and possibly more, you begin getting deals structured around the hope that future demand will validate present financing choices. Hope can be a useful ingredient in entrepreneurship. It is a terrible foundation for system-wide leverage. Now let me be precise. I am not saying artificial intelligence itself is fake. That would be foolish. There are real products, real labor savings, real improvements in search, automation, coding, underwriting, logistics, media, customer service, and research. I have no interest in pretending the whole field is imaginary. My concern is different. My concern is what happens when a real technological wave attracts so much capital so fast that the financing structure around it becomes more speculative than the underlying reality can comfortably support in the near term. That has happened before in history. Railroads were real, electricity was real, the internet was real. The fact that a technology is real does not mean every financing structure wrapped around it is sound. The market never remembers that lesson for long enough. Now let us move to the second risk, Iran and the energy channel. This part the public understands emotionally, but usually not structurally. People know that conflict in the Middle East can raise oil prices. That part is easy enough. What they often do not think through is the chain reaction. Energy is not one industry. It is an input into nearly everything. Transportation, chemicals, manufacturing, data center operating cost, construction cost, shipping, agriculture, consumer prices, industrial margins, inflation expectations, interest rate expectations, funding stress. The world keeps trying to separate finance from the physical economy. That is a mistake. The financial system is built on the physical economy, and when physical costs rise unexpectedly, the assumptions embedded in financial structures start changing too. That is exactly why a prolonged Iran problem matters so much. If it were a short disruption, markets could treat it like weather, a sharp burst of fear, then normalization. But if the shock persists, financing costs and inflation expectations stop being temporary talking points. They become part of the operating environment. And that is where private credit becomes more dangerous, because private credit often funds weaker borrowers. Transitional borrowers, highly specific projects, or capital-intensive structures that cannot absorb much deterioration in assumptions. If rates stay higher, if spreads widen, if refinancing becomes harder, if construction gets more expensive, if energy becomes a persistent cost problem, then suddenly a deal that looked manageable in a calm environment stops looking so comfortable. This is what the public misses. Private credit does not fail, mainly because one manager wakes up stupid. It fails because the environment that supported many marginal loans changes at once. Margin loans, floating rate debt, project financing, and weak borrower cash flows do not need catastrophe to become dangerous. They simply need enough assumptions to move in the wrong direction. At the same time, that is where the Iran channel matters. It increases the probability that rates, inflation, margins, and liquidity do not behave the way the original underwriting hoped they would. Now, the third risk, Taiwan. I know people have heard the Taiwan story so many times that many no longer feel anything when it comes up. That is one more reason it matters. Risks that become familiar are often discounted emotionally before they are discounted properly economically. Taiwan is not only about geopolitics, it is about the chip chain. And the chip chain is not only about gadgets, it is about the infrastructure underneath modern computing. Cloud scaling, advanced AI training, industrial systems, consumer electronics, and a surprising amount of business productivity around the world. When people say Taiwan, what they are often really saying is concentration risk inside one of the most strategically important manufacturing ecosystems on Earth. That is a completely different scale of problem from ordinary trade friction. Now connect that to artificial intelligence. The AI spending boom is heavily dependent on the continuation of advanced chip supply, on confidence that the build-out can continue. and on the belief that the required compute will remain available when the next stage of deployment and demand arrives. A Taiwan disruption would not merely affect one stock or one company, it would hit assumptions across the entire infrastructure chain, data center economics, project timing, supplier contracts, capacity planning, financing schedules, and perhaps most importantly, investor confidence in the continuity of the whole AI CapEx thesis. That matters because a huge amount of capital has already been committed based on continuity. Break continuity and the financial structures attached to the build-out begin looking much shakier. There is even another layer many overlook. The physical chip production process itself is tied to materials, gases, logistics, and stable industrial coordination. You do not casually replace those ecosystems in the middle of a geopolitical shock. Markets like to say things are priced in. A truly meaningful supply disruption in a chain this important is the kind of thing no one has really priced because no one can model it with enough confidence to feel honest. That is another reason tail risks matter more than people want to admit. Now step back for a moment and notice what we have. A giant capital-intensive technological build-out, private credit helping finance parts of that build-out and related corporate structures, an energy shock channel that can raise inflation pressure and financing stress, a semiconductor concentration risk that could alter both cost and continuity assumptions. None of these is cleanly separate from the others. That is the whole point. The danger is not additive in a simple way. It is interactive. And interactive risk is much harder for markets to price because the scenarios multiply. Now, let us come back to private credit, because this is where many people still behave as though the subject is mostly about whether some wealthy investor in a closed-end fund gets a lower return than expected. The problem is not merely investor disappointment. The problem is the funding chain. Banks lend to entities. Entities lend to private lenders. Private lenders finance weaker businesses, project structures, and non-traditional credit exposures. Asset managers mark things using models. Investors feel calm because the marks do not move every second on a public exchange. Then one day they want liquidity. That is where the quiet sentence appears. Redemptions limited, withdrawals delayed, access restricted. I take that sentence seriously. Not because every restriction means collapse is imminent, because enough collapses began with some elegant version of it that only fools ignore it. Private credit looks safer than it often is because the pricing is smoother than public markets. Smooth marks are not the same thing as smooth economics. That is one of the oldest illusions in finance. If you do not price something every second, people begin assuming it is not very volatile. You merely postponed the argument. The volatility is still there in the cash flow, in the borrower quality, in the refinancing burden, in the collateral, in the capital structure, and in the confidence of whoever thought the thing was liquid enough for their needs. That is why gates matter. They convert hidden risk into lived reality. Once investors learn they cannot leave as easily as they imagined, the whole story changes. Now, the reason I keep emphasizing the system rather than the individual product is because of what happened in 2008. Most people remember the surface event subprime mortgages, housing collapse. Fine. But subprime alone did not nearly destroy the financial system because a group of households missed payments. The catastrophe came from the leverage, the securitization, the synthetic exposure, the derivatives, the confidence, and the balance sheet interdependence built on top of the original asset. The system amplified the original problem. That is what we must always ask now. Where is the amplification channel today? I see at least four. First, private credit itself has scale and opacity. Second, AI CapEx has size and financing dependence. Third, energy shocks and higher rate stress both operating costs and funding assumptions. Fourth, Taiwan risk threatens one of the strategic supply chains supporting the entire story. That is a serious stack. And I have not yet mentioned the fifth force that ties them all together, the labor market. Because once the labor market softens meaningfully, everything becomes more fragile. Consumer spending weakens, defaults rise, corporate revenue becomes more uncertain, cost cuts accelerate, risk appetite falls, layoffs feed caution, and caution feeds weaker demand. That is how the real economy begins talking back to the financial structure. This matters because A lot of market commentary gets the order backward. People look at mall traffic and restaurant reservations and say, if people are still spending, how could recession risk be real? That is naive. Consumers often spend right into the edge of trouble. They do not stop on schedule because the market wants a clean signal. They stop when layoffs arrive, savings buffers run down, credit tightens, and confidence breaks enough that the ordinary household starts protecting itself. That process usually shows up late, not early. By the time the public sees empty stores and frozen hiring, much of the financial damage has already been done. This is why leading indicators matter more than mood, and why it matters if labor weakness starts appearing at the same time the system is carrying these other stresses. Now, I do not worship recession models. I do not need a machine learning probability chart to tell me how to think. But I respect what such models are trying to capture, which is this: the economy has weak spots, they are becoming more visible. The market may still be treating some of those weak spots as isolated or temporary that can work for a while. Then a catalyst arrives, or several catalysts arrive. That is what worries me, not the neat story. The possibility of multiple catalysts arriving in a system that has grown comfortable with continuation. Continuation is always the hidden assumption behind modern pricing, that tomorrow will broadly resemble today, that funding will remain available enough, that risk can remain financed enough, that geopolitical noise will stay mostly noise, that energy spikes will pass, that AI demand will justify the build-out, that private credit structures will remain orderly, that banks will stay resilient because the actual stress never gets high enough to test what they are really carrying. Notice how much has to keep cooperating. This is why I do not like the phrase priced in when people use it too casually. The market can price visible probabilities. It is much worse at pricing interactions between large, fragile systems, when the interactions are hard to model and the incentives of the participants encourage optimism. Optimism is always overrepresented near the top of a cycle. It is practically a law. Now, what should an ordinary investor do with all this? The wrong answer is to become a professional doomer. That is an industry too. It sells fear the way others sell greed. I am not interested in fear as identity. I am interested in preparedness as structure. And preparedness begins with one uncomfortable admission. If you feel intense anxiety about the market, you probably have too much of something fragile in your own life. Too much debt, too much leverage, too much option exposure, too much concentration, too little income flexibility, too little liquidity, too much dependence on a calm market for personal stability. That is where ordinary investors should begin. Not with geopolitical prophecy. Reduce what makes you brittle. If you owe too much, reduce debt. If you are speculating too hard, reduce risk. If your income depends on one narrow skill, broaden your capability. If all your wealth lives in one kind of asset, diversify intelligently. If you do not have liquidity, build it. Anxiety is often useful information. It is telling you where your structure is weak. I would rather hear that message early than after the system decides to teach it more violently. There is another point here that deserves emphasis. The same system risks that threaten highly leveraged structures can create wonderful opportunities for patient owners of strong assets. I never forget that. Crisis does not only destroy, it reprices. It weakens the weak and often offers pieces of the strong at prices that calm people would never have received in ordinary times. That is why I want reserves. That is why I want no forced need to sell. That is why I want productive businesses rather than merely elegant financial promises. If the world becomes disorderly, I want to be the person who can act, not the person whose main asset just gated his withdrawals or whose balance sheet was designed for one narrow, friendly environment. This is where the ordinary investor has an advantage. If he behaves properly, he does not need to outperform every quarter. He does not need to match some fund manager, S-drama. He simply needs to stay alive, liquid. And rational, that sounds too plain. Good plain things often matter most. When I look at this moment, I do not conclude that catastrophe is guaranteed. I do conclude that the market is treating a very fragile intersection of finance and physical world constraints with more ease than I find wise. Private credit is not an abstract issue. AI CapEx is not merely a growth fantasy. Iran is not just a headline if energy flows stay stressed. Taiwan is not only a geopolitical talking point when the chip chain is this concentrated. Put these together and you do not have one story. You have a structure, and structures matter most when they are strained at several points at once. So yes, this moment deserves respect, not panic respect. The kind of respect that makes you ask what assumptions you are living on, the kind that makes you prefer liquidity to bravado, the kind that makes you own durable businesses over pretty stories, the kind that makes you notice when a complex financial system has attached itself to physical bottlenecks. It cannot easily analyze, reprice, or repair in real time. That is when experienced people lean forward. I am leaning forward now because if 2008 taught me anything, it is that the great danger is not the obvious surface explanation. It is the architecture underneath it, and the architecture underneath this moment is more fragile than many people want to admit. That does not mean the end is here. It means the stack is real. And when the stack is real, the right response is not to laugh at it or worship it. The right response is to strengthen your own structure before the market decides all at once that what looked like 4 separate risks was really one interconnected system problem all along.